Hi, everybody, and welcome to the Traders Army Wealth Essentials Program. You know, the purpose of this program is to arm you with some of the tools necessary to understand what does it mean to be a wealth intelligent investor, right? We think so much about Traders Army and we think about trading and short-term investing opportunities. What we're going to talk about in today's session is being an investor. And today specifically, we're going to talk about investing with the power of compound interest. And for a lot of people, this may seem like a fairly simple concept, but it's a fairly simple concept that I think we overlook because we have to remember that the most valuable asset any of us have is the only asset none of us can get back. You know, when we think about the things we can get back in life, we can get back money, we can get back possessions, we can get back anything in life, but we can't get back time. And today we're going to talk about how time is an important element in being an investor, and it's foundational to everything else that we'll cover as we go through this series. So as always, if you have any questions about the items that are covered in today's course, please send us an email, support@tradersarmy.com, and we're here to help to make sure that you get all the support that you need. So when we think about this concept of compound interest, the things that I always think about is sometimes when we find ourselves staring down at one tree, you know, we are so focused on that tree that's right in front of us that we miss the totality of the beautiful forest, right? We get so caught up in the moment and in the now that we forget to plan for the moments, right? And so I will tell you that this is very, very common, and I see this in many, many investors. And I don't care if you're 25, 35, or 55. You tend to believe that there's always going to be time coming, time in the future. And what happens is that we just get so caught up in our day-to-day lives that we don't have a plan, and we lose that greatest commodity. And that greatest commodity, make no bones about it, is time. Now, time combined with return is really where compound interest comes in. And that's really what today's session is really focused on, is understanding time. You know, Albert Einstein says that compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And so as we go through this today, we want to really start to think about how does compound interest impact you as an investor. So let's look at three investor profiles, right? I want to look at three investor profiles, and we're going to look at Mike, Eric, and Amber. And Mike, Eric, and Amber are going to invest exactly the same way, right? So we're going to look at a scenario in which all of them invest $6,000. They invest $6,000 to open up an account. Call it a retirement account, call it an IRA. It doesn't matter what type of an account that it is, but they invest $6,000 into the account. And they're going to add $6,000 a year for the next 11 years. That's it. So we're trying to keep it very simple. Everybody's on the same. Now, let's assume an annual rate of return of 6%. So we're not going with a crazy high rate of return. We're going to assume an annual average rate of return of 6%, which, by the way, that's an average rate of return, which means some years it'll be greater than 6 and some years it'll be less than 6. Matter of fact, some years it'll be negative. But assuming an average annual rate of return of 6% over the life of the investment period. Now, for each of these different investors, they've got a target retirement age of 70. And so we're going to look at what does the capital look like when your target retirement age is 70. So all three of them are going to invest exactly the same way, and they all have the ending target date in mind, but all three have different time horizons, right? So let's start with Mike. Now, Mike, he's going to start to invest at the age of 50, right? Maybe Mike has been working his whole life and he hasn't thought about retirement, or he hasn't put money away, and so he's got 11 years of accumulation. Now, remember, we're starting the account with $6,000, and we're adding $6,000 a year for 11 years. So the total amount of money that is saved is $72,000. Now, that's going to mean that when Mike is done putting money in, he's going to be 61 years old. So that leaves Mike 9 years of compounding returns after accumulation. Now that means that at age 70, his capital is going to have grown to $171,000. which means that essentially he's going to have more than double the amount that he put in. And that's because he gave himself 9 years of compounding return after the accumulation phase, right? If we think about it as an accumulation and a maturation phase, the accumulation phase in this case is 11 years, the maturation phase is 9, and his capital at age 70 is about $171,000, assuming that return. Well, this is because Mike started at age 50. Now, $171,000 is certainly nothing to shake a stick at, but it may not be enough to help Mike reach his retirement goals. Well, the biggest thing that Mike did was he started at age 50. Let's go take a look at Eric. So Eric, he starts at age 40. Now, Eric does the exact same accumulation period of 11 years and saves the exact same amount of money, which is $72,000. The difference is that Eric is 10 years younger. And so Eric, starting at age 40, is going to have 19 years of accumulation to account for. And what that means for Eric is that the capital that he will have at age 70 is about $306,000. So when we go back and look at Mike, Mike was looking at about 171. Eric is looking at $306,000. So not quite twice as much, but almost. And that's just simply due to the fact that he has more time. Right now, the amount of money saved is still $72,000, but now Eric has over 3 times the amount that he saved in the total amount. Now let's go take a look at Amber. So Amber, she's going to start investing at the age of 30 and going to do the exact same thing. She's going to have 11 years of accumulation, and she's going to have a total of $72,000 saved, but she's going to have 29 compounding years after accumulation. Now, once again, this is still under the assumption of a 6% rate of return on average, right? Meaning some years will be more and some years will be less. Now, Amber's capital at age 70 is $548,000. So when we compare these 3 investor profiles, Mike at 171, Eric at 306, and Amber at 548, we can see that the only difference in these 3 is time. That's it. It's the only difference. Well, what's interesting is that we as investors cannot go back in time. We might want to go back in time. We would be dying to go back in time, and I think that the most valuable piece of equipment ever created would be a time machine. But we can't do that. So what we have to do is we can't change our age. What we have to change is our rate of return. We've got to know what is our number. What is your number? And this is an important concept to consider because as an investor, you know, we talk a lot here at Traders Army that your goal is to live the life you choose to live. Live life on your terms. Well, the way that you can live life on your terms is by deciding at what age do I want to retire. Now, what I do then is I work backwards. If I know what age I want to retire, I can then work backwards to see how I want to get there. So a couple of key considerations that we need to think about. So the first thing we're going to do is we're going to say, well, what's my current age? And you've got to put in your current age. And your current age is important because that tells me, okay, what am I going to look to put in? What age do I want to retire, right? And not what age am I going to retire. It's what age do I want to retire? And we can, like I said, work backwards from that number. You then have to ask yourself, how much capital am I starting with? What do I have? What kind of a bucket do I have today? And then how much capital am I saving annually until retirement? These are key questions for us to make sure that we put in so that we can really get a baseline of how much capital am I going to have to put in order to save. Well, then I need to ask how much money I'm going to need to live the life I choose to live in retirement. I've got to have at least an idea of how much money I'm going to need to live my life. And oftentimes people say, well, I can live on less and I can have my house paid off. And remember, this is not the amount of money that I need to live. It's the amount of money that I want to live so that I can do my absolute best in retirement. You also have to ask about the expected rate of inflation. What's my inflation rate going to be between now and retirement? Because certainly a gallon of gas is going to cost more 20 years from now than it does today. A loaf of bread is going to cost 20 years from now more than it does today. And we're going to have to see, what does that look like? And then another question is, what can I expect from a government pension plan? And what does that look like going forward? So how do I account for all of these variables? The way that I account for these variables is the use of a retirement planning calculator. And this retirement planning calculator is a tool that's available at Traders Army that you can use in order to come up with your number. So let's go take a look and see, what does that retirement planning calculator look like for a particular situation. So here's a retirement planning calculator that you can use at tradersarmy.com. And the purpose of this retirement planning calculator is to put in the numbers that make the most sense for you. Remember, our goal is to live the life we choose to live, not the life we're forced to live. So we want to put in here are numbers that you would like to see happen, right? So we're going to start with some basic numbers in this planner. Now, there's some. If you go to this retirement planning calculator, at the bottom of the page, you'll find some definitions of each of these different lines. But we're going to start at the top. Now, current age, very simple. You put in your current age, and if your current age is 50 years old, then certainly put in 50 years old. Now, age of retirement. What age do you want to retire? Given a magic wand, at what age would you retire? If that number is 75, then put in 75. If that number is 55, then put in 55. The whole goal here is to put in the age that you want to retire. Now, I'm going to put in 72 for the sakes of this for this exercise. Let's just put in 72 as our number. And that means we've got 22 years of working, going forward. Now, annual household income. How much is your current annual household income? What are you bringing in from your current employment? Now, this might include employment. It might include employment plus whatever if you own a business or if you've got additional income. But the idea is I want to try to match my current income as much as I can. So for the sake of this example, let's use $75,000. Now, percentage of income to save. How much income are you of that $75,000, how much are you putting away each year towards retirement? And how much will you continue to be able to put away? Whether that number is 2% or whether that number is 20%, everyone's going to be in a different bucket. The default here is 8%, and we're going to start with that default number. Now, current retirement savings. This is how much do I currently have earmarked for retirement? Now, this is the money that is liquid. In my mind, this does not count things like homeowners' equity. This counts the capital that I can live off of and I can get to very quickly. This would count things like 401k plans, 457s, 403bs, individual retirement accounts, TSPs, any of the other pension plan schemes that I may have structured depending on where I live in the world. It could also be just a savings account, right? It could be money that's held in an annuity. It can be the cash value of a life insurance plan. These are all current retirement savings that we can attribute. And let's just say for the sake of this example, we have $150,000 put away. So we're at age 50, we've got $150,000 put away for retirement. Now, expected income increase. Let's say that we've got an expected income increase over the next 22 years of 2%. And then we talk about our pre-retirement income desired in retirement, meaning based on how much I make today and how much I'm going to make with my expected raise going forward, when I retire, do I want to change my standard of living? Now, according to this, I'm going to reduce my standard of living by about 10%. I'm going to bring in 10% less income. Now, the idea here being a lot of times people will say, well, you live on less in retirement. And I always answer that with why. Why do I want to live on less in what's supposed to be the golden years of retirement? So I believe you should leave that number at 100%. So you don't change your standard of living. And let's try to work. Remember, we're magic wanding here. We're trying to live to the life we choose to live. Now, years of retirement income. If we retire at 72, this is years of retirement income 35. This is planning that this is basically saying we're going to live till 107. Now, we also see that there's a continuation of life much longer. Depending on on where you live in the world, there's going to be different numbers to look at. I believe it's important to plan until the mid-90s. I think planning until the mid-90s gives you a fair amount of leeway for most people on average, but let's plan until the mid-90s. You can certainly go higher. Now, miscellaneous income or pensions. What other pensions do you have coming in? Do you have a pension from a job that you worked in, when you were in your 20s or 30s that you've never really counted on, but you're going to start to receive it? Do you have a lump sum and do you have an annuity payment that's going to be coming to you in a form of an annuity pension? Are you going to receive maybe rental income going forward. This is where you would include your rental income. If you've got a rental property, maybe you have a spouse who's passed away and you're receiving Social Security income from there. So that's where this would all go. I'm going to leave that blank for now. And the last two are retirement work income. It's per month, how much money do I plan on making in retirement? So if I'm going to go get a part-time job, now this is retirement work income. This is important to note. This is done on a monthly amount, right? Monthly amount from retirement work or employment. So this is not done on an annual basis. Whereas the number up here was annual, the one down here is monthly. So let's say you get a part-time job and you make $2,000 a month. That's where that number would go. We're going to leave that number at zero because we're going to assume you don't want to work in retirement income. Now, if you decide to work in retirement, you can put how many years do I plan on working in retirement. So, for example, maybe you retire at 72 and you plan on working for 8 years. You want to work until you're 80. Maybe you get a part-time job making $2,000 a month. That's where that number would go in. We're going to leave both of those numbers at zero. Because we're going to assume that if you're learning this and you're doing this, that your goal is not to work in retirement. Now, these are our basic numbers. Now there are some givens in here that include investment returns, inflation, and Social Security. So opening that up, we can see that our rate of return before retirement is set at 7%. So this is assuming we're going to average 7% a year in our working years. And then when we retire, because we're going to be a little bit less aggressive, we're going to go down to 4% a year. Now, our expected rate of inflation is 2.9%. And when we look at our expected rate of inflation, this is based off of the GDP number. That number is usually a little bit higher than 2.9% because it doesn't always take into account some key things, such as energy or food. But when we look at our expected rate of inflation, we want to make sure that we always take that into account. I usually take that number up a little bit, and I would say 3.5 is probably a slightly better number to take a look at for the inflationary rate of what we can expect. Now, if you believe you're going to collect Social Security, make sure that you click to include Social Security. And at the bottom, it's going to give us our number. So according to this, we're going to have about $936,000 when we retire, right? So our $150,000, if we work for 22 more years, we put 8% away of our $75,000, we continue to put that away, and we get 7% a year return, we're going to have nearly $1 million upon retirement. Well, this assumes annual retirement expenses of $113,000. So this is 90%. This is 100% of our last year's income, which was $113,000. So where does that $113,000 come from? That $113,000 comes from this current $75,000, but we're going to work for 22 more years and get a 2% raise each year. So this would be our final year of work. This would be our salary. Now, if we do this, this is going to assume that we are going to have more expenses than we are income because our total expenses are going to continue to grow, and we're going to eat away at the money that we have in our retirement account as we are going to be taking money out faster than we're replenishing it. So in this case, we're going to run out of savings at age 87. Now, you may look at that and say, oh, okay, 87 is pretty good. If I die broke and penniless, at least I've lived a long, happy life. And that sounds all fine and dandy until you're 85, right? and then you see that you don't have as much as you expected to have. So what can I change? What can I change, right? What does it tell me that I should do in order to live this life the way I want to live it? Well, what most people would say in order to get there, they tell me you need to save more. So now I've got to talk about how much more should I save. So instead of saving 8%, let's save 10. So now in saving 10% a year, what that does is now I run out of money at age 89. So by saving 10% instead of 8, it adds 2 more years. And now I have over $1 million at retirement, and I'm still going to run out of money. Well, what do they tell me to do? I need to save more. So instead of saving 10, let's save 12. And if I save 12%, now I run out at age 90. I've got almost $1.1 million at retirement. What you can see very quickly is that saving more, right? Let's say I save 20% of my income. Now I still run out at it, but this time I run out at age 96. My point is that, by the way, the answer is always you need to save more. So I don't think saving more is the answer. I think what we need to do is take a look at our rate of return. So currently, our average expected rate of return is 7%. What if we take that number and we make it 9? What if that number was 9% before retirement? Well, now take a look at that. Taking our number from 7 to 9 takes our retirement savings from age 87 all the way out to age 94. Now, what about our rate of return during retirement? Maybe we're a little bit more aggressive during retirement and that number goes to 6. Now take a look at what happened. We just found that our balance at the end of retirement is a little over $600,000 because our rate of return is enough in order for us to live the life that we choose to live. Right? Now we can start to really play with it and say, well, what if I don't want to retire at 72? What if I want to retire at 67? Well, if I retire at 67, now I run out at age 82 because I lost those 5 years of working. Well, what can I change? Well, instead of doing 9%, what if I do 1% a month and I get a 12% rate of return, right? At 12% rate of return, I'm barely going to make it. I've got a little bit of money left, but maybe in retirement I'm a bit more aggressive, right? And now I have plenty of money in retirement. Now my point is, you could do this all day. But the key, the numbers that we look at is the rate of return before retirement, as well as the rate of return during retirement. So your homework, if you will, is to fill out this retirement planning calculator and to come up with your number. Come up with your number of what you think that number needs to be in order to live the life you choose to live, not the life that you're forced to live. So hopefully that makes sense to everybody. And if you need help or you need some support with this, please send us an email, support@tradersarmy.com. Obviously, we're here to do our best to make sure that you have all of the support and the help that you need, and we will see you in our next Wealth Essentials class. Talk to you soon. See ya.